Let's look into face value and market price. Why does a bond with a face value of rupees 1000 sometimes trade at rupees 950 and sometimes at rupees 1050? This is one of the most common questions people have when they first start looking at bonds. And that's a very fair question. Because when you are new to bonds, this feels a little confusing. To understand this properly, we need to separate two ideas, that is face value and market price. Let's start with face value. When a bond is issued, its face value is fixed. Face value is also called par value. It is the principal amount that the issuer has committed to repay by the end of the maturity date. This number is written in the bond terms, and once the bond is issued, this face value never changes. A rupees 1000 face value bond will remain a rupees 1000 bond till maturity, no matter what happens in the market. What does change is the market price. Now let's look into market price. Market price is the price at which the bond trades today. This is the price that buyers and sellers agree on in the market, and this price can move up or down over the time. Let's understand this with a very simple example. Imagine a bond is issued with a face value of rupees 1000 and it has a fixed coupon of 8% per annum. What does that mean? It simply means the issuer will pay rupees 80 every year as interest. This rupees 80 is calculated on the face value, not on the market price. So whether this bond is trading at rupees 950, rupees 1000 or even rupees 1050, the annual interest payment remains rupees 80 always. This is why face value acts like an anchor. It defines how interest is calculated and how much funds you will get back at the maturity. The market price, on the other hand, reflects something else. It reflects what investors are willing to pay for the bond today. And this willingness to pay depends on many factors. Let's go through them one by one. One of the biggest factors affecting bond prices is its interest rates in the economy. When market interest rates rise, new bonds start offering higher interest rates. So what happens to older bonds that are paying lower interest rate? They become less attractive. As a result, their prices tend to fall. This is why when interest rates rise, existing bond prices usually fall. And when interest rates fall, new bonds offers lower coupons, so existing bonds with higher coupons become more attractive. As a result, their prices tend to rise. This does not affect the face value, it only affects the market price. Another important factor is the credit quality of the issuer. If the market feels that the issuer has become stronger, more stable, more reliable, then the investors may be willing to pay more for that bond. On the contrary, if the issuer's financial conditions appear weaker, investors may demand a lower price. Same bond, same face value, same coupon, but perception changes, so price adjusts. Time remaining to maturity also matters, which is the third factor. As a bond moves closer to its maturity date, its market price tends to move closer to its face value. Why? Because the certainty of repayment gets closer. There is less time for things to change. So a bond that matures next month usually trades very close to its face value. Like any market, bonds are also affected by demand and supply, which is the fourth factor. If many investors want to buy a particular bond, its prices can go up because of demand. If many investors want to sell the same bond, its price can come down because of supply. This has nothing to do with the face value, it's just the market behavior. So when you see a bond trading at rupees 950 or rupees 1050, remember this: the face value has not changed, the coupon amount has not changed, the maturity date has not changed, only the market price has changed. Once you clearly separate face value from market price, bond pricing starts making sense. You stop asking, why is this bond cheaper or costlier? And you start asking, what is the market pricing in right now? In the next video, we will take this understanding further and talk about primary versus secondary market because that's the number that connects price and the return.